ex-lender, I would say the last 60, 90 days, almost exclusively on the multifamily side, we've actually been talking with lenders.
Hello, best ever listeners. Welcome to the best ever CRE show. I'm Ash Patel and I'm with today's guest, Sam Morris. Sam is joining us from Katy, Texas. He is the CEO of Sunset Capital. They are owners and asset managers in multifamily and storage. Sam's portfolio consists of 1,300 units of multifamily and over 2,000 units of storage. Sam, thank you for joining us, and how are you today?
Ash, doing great. Thanks so much for having me on, man. It's great to see you, bud.
It's a pleasure. You're a bit of an anomaly. You do self-storage and multifamily. Did you pivot from one to the other, or do you still do both?
No, we still do both. Matter of fact, I literally just got off the phone with our asset management team and property management team for our storage side, and we meet every Wednesday at 1:00 and go through our portfolio and then go through what's new out there in the market. And we have another kind of separate side that just does multifamily. So it's great to do both.
How did you get to where you are today?
Yeah, great question. So, I actually started as a corporate banker by education. That was my background. So, I right out of college was a banker, and all I was doing as a young age was underwriting deals. That's literally all I did all day, every day for years. And not just necessarily real estate deals alone, but all kinds of deals. And so it was in my about mid-20s that I started looking at all these deals we were lending money on and how these guys were making all this money on things. And so I was able to start investing as a passive investor back in 2007 into these larger deals, and really had just a great understanding of how they worked, both on the macro side and the micro side. And it was more of just making sure you had the right sponsor and the right operations management teams. And that's how I actually got started, was a passive investor in these deals.
2007, did that story not end well?
It's kind of funny. The story actually ended up really well, because at that time frame, we were buying things at, I would say, probably 20% of what we're able to buy them today. And as long as you had the right operators, we financed it the right way, and you were able to operate out of a lot of those issues, say in the 08, 09 arena, when we got through all that, it was actually highly beneficial, and we did really well from a passive standpoint. And there were a lot of battle scars along the way, but it was things that we learned from too. And so it's definitely shaped and molded to where we are today.
When did you start doing your own deals?
So in about 2012, I actually started raising money for real estate and doing more of the asset management side. And then it's with Sunset Capital. We actually fully launched Sunset Capital 3 years ago when I actually retired from banking and sold my last bank. And it was a great and wonderful thing to springboard off of. So everything you see now is actually Sunset Capital specific.
2021 launched this business. Mm-hmm. It was a good time post-COVID.
Sure.
And then rates started shooting up. How did that affect you?
Yeah, so I would say slightly, not too terribly much. Being an ex-banker, I was fairly in tune with what was going on with the interest rate world and the interest rate markets, and conservative by nature too. So a lot of what we were doing was fixed rate financing, because we were, I had gone through, 2007, 2008, 2009, and had the battle scars of things, and known and seen what can happen in that world. And so we weren't impacted as much as some of our other peers, just because we kind of handled things a little bit differently on the front end.
Did you have deals? If you're in multifamily, the assets that you had to have been reduced in value over the last 2 years. Can you give us an example of some of those and what you're doing to remediate that?
Yeah. So I have an example of a deal that we acquired in 22. And, when we acquired it, we had several reserves that were built into it. It was a smaller deal too, but I would tell you the valuation of it, as rates went up, so did cap rates. And so the valuation has been one of those things that we've had to try to outrun our NOI projections to try to maintain value with it. We have significant reserves there, so it's never been a thing where we're doing cash calls or anything of that nature, but there are other things that have occurred that could be very beneficial for that particular project. And it's things that we've actually learned from the past too. And with that particular project, we had a hurricane earlier this year, and we do have damage at the property. And so one of the things that we're going to be doing is we have a fairly large claim in right now of significance. And when you get things like new roofs and things of that nature that are brought into the property, it significantly helps from a valuation standpoint. And what that's going to do is it actually is going to probably push the sale date a little earlier than what our business model was, because of all the things that we're going to do from a value add perspective to it, that another buyer will be able to come in, and we're going to we'll do all right with that property. Are we going to hit it out of the park, hit a home run with it? No, but are we going to be making money? Yes. And so it's certain things like that. And, that was an act of God that actually is going to be something that's truly beneficial for us, that helped us. But it's also knowing how to take advantage of that and make it right for your investors and for the next buyer.
No one ever thinks about the silver lining after a hurricane, but what a great point.
Yeah.
Today, we're approaching 2025. Both asset classes are a little bit unique. People are still chasing self-storage, but the prices have come down a little bit. Let me rephrase that. Let's edit that out. People are still chasing self-storage. It's still a sought-after asset class. There's a lot of pain in multifamily. How are you positioning yourself to capitalize on all of this?
Yeah, so I would say so remember, ex-banker, ex-lender, I would say the last 60, 90 days, almost exclusively on the multifamily side, we've actually been talking with lenders. And where we're located too, which is a suburb of Houston, Texas, there's been a lot of pain here, not just because of interest rates and not just because of supply-demand imbalances, but more so insurance. The aforementioned hurricanes we spoke of has gone up at an astronomical level. That's an uncontrollable expense. We live in a high property tax state from the standpoint of those are uncontrollable expenses. I mean, we're fighting our property taxes each and every year. So there are a lot of things in these new purchases that are baked into these deals that maybe weren't done as well, let's say in that 21, 22 era in underwriting, that we fully have underwritten into deals. And now we're speaking more to the lenders of those deals, because those that have acquired them in that time frame are struggling to get through, and they're looking for potential exits, as are their lenders. And so on the multifamily side, I would say for the last 90 days or so, we've been talking specifically with a lot of lenders of how we can come in and help turn a non-performing asset into a performing one for them. On the storage side, it just didn't have that kind of distress. It just hasn't. It's not as impacted the way multifamily was. And so there's still a lot of people, I would say we're having to turn a lot of deals over, because there's still a lot of people that are very proud of their properties. And if they're at a point where they want to sell, the bid-ask spreads are still pretty substantial in storage as well.
You have such an advantage of being a banker, talking to bankers, trying to get deals out of them. How do those conversations work? From a layman's perspective, we know that lenders don't want the toxic assets, but they also don't want them back, and they don't want them on their books.
Correct.
So they did the blend and extend first, and hoping things would correct themselves. That hasn't really panned out. So then it is pretend and extend.
That's right.
At some point, you got to pay the piper, and you have a toxic asset potentially declining in value. How do you have those conversations, and what is it that the lenders are really after?
Yeah, so I would preface it first. So I was a corporate banker for 18 years. They have their own vocabulary. Just like in the real estate world, we have our own vocabulary, and they are different ways of speaking. And so knowing how to say, what to say, when to say it, right, and the tone you need to use when you're speaking to them is that kind of advantage that you need, because it like one of the things I just said, I'm taking a non-performing asset. That means something very specific to a banker, and I can help them turn it into a performing asset. Now that means a lot of things in the banking world, because when you look at their balance sheets in banks are very different than balance sheets for all other companies, right? And the easiest way I could say that is loans are assets and deposits are actually liabilities, right? So it's a backwards way of looking at it. And so if you have an asset that's not performing, it's even worse, because banks are highly leveraged businesses. So if you have an asset that's not performing, it outsized impacts the equity of the bank. And so if you can come in, present yourself as an option to help them in that scenario, where I can help them from an outsized position improve the equity of the bank by helping them with this problem or problem asset, and you present it to them in a manner of, here's what I'm going to do to help you out, and this is what I need for me to be able to help you out, it's something they're very open to, because they do not want to operate property. That's not what a bank does. It's not what lenders do. They want somebody who's going to take this problem, kind of wrap it in a pretty bow, and I can help turn it over to where you're not going to have to answer for it, because it's no longer going to be seen as a negative on the balance sheet, because I can help you turn it into something good, right? And the way you articulate that, and when you articulate that, and how you're able to explain it to them can get them comfortable with you, along with your track record showing why you can do it and how you're going to be able to help them out. And that's kind of the benefit of the way of how you speak to lenders is very different than the way you would speak to a broker or a seller or somebody else, because they're motivated differently than people in real estate.
Let's dive into that. You sound like a magician, so let's walk me through that.
Okay.
One, what does lender hate more, having a toxic asset on their books or having to take a loss by disposing of it? What?
I would say, they're somewhat similar, but if you got to take a loss, right? If you actually have to take a loss on an asset, as long as you can calculate what it is and what you're going to do to be able to get around that or get over that, you can actually work with that. It's sit there and go, okay, we're going to lose X amount. And, each and every year we have a loan loss reserve, right? Every deal they bring in, right, they're accounting for some amount of money for a loan loss reserve, i.e. there's expectations of loss with the portfolio they have each and every year, right? There's some number they know they're going to write off, right? If you have a toxic asset, though, something where you don't know how bad the loss is or you don't know what it's going to be, there's uncertainty with that. Bankers like certainty, right? So even if there's a loss, I know what it is, I know what it's going to be to get over that, right? That's something they can work with. It's when they don't know how bad it is, all right? So use, for instance, a multifamily deal. Let's just say it's a 200-unit property and it's at 75% occupied. They may or may not know how bad those units are. They may or may not know how much deferred maintenance they have. Now, they're going to hire inspectors to go out there, and it could be, hey, this could be a tremendous amount of work. They typically are not going to have in-house construction management and people to go out there and watch this type of property. That's not what lenders want to do. They want to get out there and lend money to other assets. So a loss, right, is something known. I know I'm going to lose X amount of dollars if I sell it at this, but I also know I'm not going to have to waste time doing any other things. I can sell it at that and we can move forward. The toxic asset, where it's an unknown and there could be additional work, both in labor, additional costs, things like that, that's scary, right? It really is. And so a lot of these times when these guys are taking deals over, they don't necessarily know all these things. So it becomes that toxic asset that you're describing. And when you come in and go, look, I'm somebody who handles these kinds of things, and I can make it to where your loss is limited, right? By working out whatever deal we want to do, or even better, I can take something that you haven't, maybe let's say you haven't been getting paid on it. I can make it to where if you lend me a certain amount of money, right, I can make it to where you start getting paid on it, right? And I can take something that was lost to you and help you limit that loss. And so it's the way you describe it back to them that helps them. And you got to remember, right, from a banker's perspective, this is not the business that they're in, right? And they like known quantities. They like to know what things are. So if there's loss, I know what that's going to be. And the bank knows how to react to that. The lender knows how to react to that, right? And so that's how you work it.
So your solution is you're providing a stopgap and certainty.
Correct.
Okay. That makes a lot of sense. Now, I think from the layman's perspective, people out there just call lenders, hey, what do you have? Or maybe they're a little bit more savvy and say, can I talk to the REO department? But that's not really the way to approach it, is it?
No, because, well, it's hard, right? But to starters, right, I've been in the industry a long time. So I'm a known commodity back to the people I'm speaking with. And if you sit there and go, look, I'll help you limit whatever this is, it's literally, let me help you, right? But I also speak it in a language that they're going to understand, right? If somebody's calling, you have somebody who's just calling up saying, hey, this is what we do, what deals do you have that are going bad, right? there's a certain amount of disclosure that they're probably going to be willing to give you, which is slim to none. But if you go through it and go, look, this is the type of stuff that I'm looking for, right? If you have something that fits this box, understand I'm somebody who can help you get out of this, right? And so it's a little bit different from the standpoint of I go back and tell them what our niche is, what we're looking for, and what we can do, and then the track record we have to improving that. And it's a totally different conversation at that point, right? Because from there, they'll go, all right, well, I may not have that, but I have something like this that could be coming up in the next 30, 60 days, right? They can't tell me maybe exactly what it is for disclosure reasons, but they say, is this something you can do? And it would be like, well, maybe that fits, maybe it doesn't. How soon do you want to be able to get me involved?
Yeah, so that is such great advice, because calling a lender and saying, hey, what toxic assets do you want to offload is like asking somebody, hey, what diseases do you have?
Correct.
They're not going to want to disclose their pain points, but the offer to help, I love that. How have you been pretty successful with that strategy?
Yeah, from the standpoint of what we've looked for and how we've been doing it, a lot of times it's understanding that, and you know, I'm kind of a matter of fact guy. So a lot of times it's, hey, look, when you guys did this loan, this was the environment you did it in, right? Today, we're not in that environment, right? And therefore, whatever loan loss reserve you may have associated with this particular deal, the fact that you haven't been getting paid on it and it's actually been deteriorating in value, let me help you out with a valuation of what it really will be. So a lot of it is actually educating them along the way of what it is, of what their expectations are from just the bricks and sticks of it, or what they look at, and a piece of paper that says this is what it's worth from, you know, whenever they did the loan 2 years or 3 years or 4 years ago, whatever it may be, and go, hey, you're not in the same scenario. And even you can go out and get another appraisal done. Tell us what this is today. It may or may not be worth that to what an actual buyer is going to have to come in and do to it. And so a lot of it is educating them along the way. And so this, you know, I would suspect maybe in 25, we'll have probably a little bit better success with it, but it's taken this long. I mean, we actually started anticipating this back in 23. It just didn't have it happen because of the extend and pretend, like what you described earlier. They were kicking the can down the road. And you really have to get to that ultimate pain point where they go, yeah, we're going to have to take this back because we're not getting paid on it. And regulators are telling us this is now something we have to put on our ORE and that we need to own and figure out a way to dispose of the property to limit our loss.
You're doing a lot of homework ahead of time, arming yourself with this knowledge before you approach the lender, right?
Correct.
Okay.
Correct.
And again, the importance here is to stress you're going in there to educate them, work with them, essentially build a relationship with them instead of saying, hey, what can I buy for dirt cheap?
Yes. Well, and a lot of times I would tell you, just because of my past, right, the relationship's already been built. And so it could just be an extension of other conversations we've been having for a long time, right? Whether personal or otherwise. And so it's not necessarily, they know the business I'm in, and it's more of educating them of, hey, here are the things that we can do, and here's what we've done. You know, hey guys, here's what we've done in 24, and these are the amount of units we've taken down, and this is the kind of stuff we've been doing. And man, we're still open to helping out, you know, in several different ways. And so we've had several approaches just for asset management services going, hey, we want to own it. You know, we think we got a property management group. Will you come in and asset manage? And because we think we're going to have to operate out of this so that we limit our loss even more, right? And we're open to some of those relationships depending on, you know, how it looks and, you know, how we can structure them.
There again is your offer to help. You don't really want to manage 2,000 more units that you don't own.
Correct.
You're doing it to pay ahead of time and build that relationship.
Without a doubt, because there could be something else at the end, or we may be the obvious exit partner too at that point as well.
Sam, I know you've been out of the business for a little bit in terms of banking. There's a lot of talk about shadow losses where bankers haven't written down those paper losses that they have. Is that a concern that can be systemic?
Not really. So I'll disclose this. I actually still sit on the board of a bank. And I was part of a group that helped start a de novo bank a little over 2 years ago, which just means from zero. So small community bank here in Katy. And so I'm actually still relatively involved at a board level, so not a day-to-day level, of understanding what's going on in the industry, and still get to, have communications with regulators and things of that nature and the Fed and understanding where their mindset is for interest rates and things of that nature. But, when you talk about shadow losses and things like that and mark to market for actual deals, some of that's already occurred. But what I would tell you is the loan loss reserve system that they have, it constantly gets updated. I mean, I would tell you a lot of the banks and institutions out there have been building up their loan loss reserve in anticipation of potential CRE distress, right? And so they've been building it up over the last year or so. And a lot of that didn't come to fruition. And it's very much, I would say, very specific to the type of asset class and in the type of market that it's in. So if we were talking about, office, it would be a different conversation, right? The loan loss reserves are going to be built up a lot larger for that than they will for multifamily or storage. If we were talking about industrial, it would be a lot less than, it is for office. And it also depends on where you are, because the type of assets that they have definitely impact that number. And I would say, as much as having, shadow losses or whatever, you have to understand if they are a regulated body, i.e. a bank or a credit union or something like that, it's not just internally to shareholders that they're answering to. They have governing bodies, whether it be, the OCC or their state, that they're having to answer to, as well as the FDIC. And so there are a lot of people looking at everything, not just internally at the bank. And it doesn't matter if you're public or private. They all have to answer to that. And so I would say that overall, most institutions do a great job of making sure that their reserves are adequate for what their specific needs are.
That is comforting to know. Good. Thanks for sharing that. Do you invest only in your local market, or what geography are you in?
We're state of Texas. For storage, we will go outside the state because we have a pretty robust management platform that we partner with. It's really coast to coast. But for the most part, we stay in the state of Texas. And if there really is anything outside of that, I would say there's a knowledge gap. We understand Texas really well, so the bulk of our investor dollars are going to be here. But if we go outside of that, we really got to have a partner who knows what the heck they're doing and has boots on the grounds locally in that market for us to kind of go along with them.
Sam, you retired and now have over 1,300 units of multifamily and over 2,000 units of storage. I would imagine you're still defensive with your time. So what systems and processes and people have you put in place so you're not overwhelmed and back to the grind?
Yeah, no. So I work with a lot of great people, and there's nothing that's going to, even from a systems perspective, there are things that can help make you more efficient. But the people that work with us, work within Sunset Capital, I mean, these are high intelligent, high capacity, high performing people, and they are great at things that I'm not. And that's actually been a really differentiating factor for me to really expand and continue to grow, is that I've surrounded myself with some really awesome people, right down to, I would say right up to, any of the C-suite people here. But really, you go to the boots on the ground. We got some great team and staff members that are just really helpful. I mean, just getting off the last call, I had two regionals that were on the call. We were going over, and man, they are superstars. One of them, she described herself as Patrick Mahomes today, because she was fourth quarter was her quarter, and she's gonna knock it out, and that's how she described herself. And I was like, my gosh, that's the winner I want to be working with. So I would say people is probably the biggest thing. As far as systems and processes that are in place, we try to automate as much as we can. When it comes to things like dealing with investors, nothing's going to beat face-to-face contact. Nothing's going to beat an actual phone call. I'm a little old school that way because I've been raising money for a long time. And, I always used to say no email is going to encapsulate a face-to-face meeting. No email will help you convey the message you're going to want to convey better than talking to somebody. And so we still do things a little bit old school that way. And to us, it's part of our competitive advantage too.
Sunset Capital, you guys actually manage your own properties. You acquire them. Do you invest in other people's deals as well?
We will, absolutely. We'll co into other deals. And normally it's a leverage thing, meaning we got to know that they have the good property management in place. And our due diligence for co-ing with somebody is pretty extensive, almost to the point where not many people probably would even want us as a co. because before we even agree to do it, one, it's going to take a lot of time for you to get to know us. So if you just have a deal and expect us to jump right then and there, it's probably not going to happen. But we want to see your office of operations. It's great when there's people that say, yeah, here I am, and I have 4 other C-suite people. And it's great to meet those people, but we want to meet the mid-level managers. We want to meet the people that are actually doing the work, because that's going to be the people that are executing on the business plan that we're helping asset manage. And so it's a little bit different because we dig in probably a little bit more. We also do all the underwriting ourselves. So it's great that you have your set of underwriting the way you do it. We're going to put it through our own and make sure that it actually is going to match what our investor expectations are.
You physically go to their office and check it out?
Absolutely.
Let's go. I love that.
Absolutely.
Good. How important is track record for somebody that you're partnering with? What if they had a couple of losses?
Just tell me the circumstances associated with that. Look, nobody bats 1,000. If anybody bats 1,000 and says that they do, I would actually be a little worried about that. But no, you have to explain the skeletons you got and why and what you did and how you've learned from it, because those are actually the people that I probably still want to invest with, because they've made mistakes, they've learned from those mistakes, and I know they're not going to make them again. And so somebody that has battle scars is absolutely still worthy to invest with.
What's been the secret to your success in scaling? This is a lot in a pretty short amount of time.
Yeah, I would tell you probably going back to surrounding yourself with the right people and really focusing on those things that you don't do well and finding the superstar that does and plugging them in, and then making sure you gel well as a culture from that perspective. And for us, it's really critical too, but also transparency with your investor base. Because as you have equity, you're able to do deals. If that dries up, it doesn't matter how great you are. If you don't have the access to equity, you're just not going to be able to do a deal. And so that kind of consistency, the open dialogue that you have with our investor base, it's really helped us to continue to scale. And even into 2024, we'll end up doing 5 deals in 24, which isn't a whole heck of a lot of deals, but for us, that's a big deal. It's worked out really well for us this year.
Are those multifamily or self-storage?
4 multifamily and 1 self-storage this year.
Are you devoting more resources towards acquiring multifamily?
Probably not, but I would say a lot more of my time has definitely been focused that way, just because of the conversations that are needing to be had with the aforementioned lenders we spoke about. It's good if I'm the person on the phone with those.
Is there still more pain to come in multifamily? Or people, a lot of posts out there say, oh, we've bottomed out, we're good to go, let's ride.
Well, oh man. Yeah, this crystal balling it, I would say it's going to be it'll be very specific to where you're located. I would say in Texas, we're chewing through the supply-demand imbalance rather quickly, even faster than I would have anticipated. But there's still a lot of pain that's out there. And whether that's taken care of in the next 6 months or in the next 18 months, I'm not positive. But it does feel like the price points that we're at right now and the stuff that we're able to acquire right now, I think we're all going to be very happy about 2-3 years from now. I'll put it that way.
The playbook for multifamily teaches most people to do bridge loans or interest-only loans when they acquire properties. Does that apply to self-storage, or do most people use fixed debt for self-storage?
It depends on the type of deal. So the deal we acquired this year was a C of O deal, so completely empty. We got it brand new, so it was a lease up. And so for us, there was no permanent debt option available, so we had to take it to a bank. And the bank, happily did it for us. And it's a little bit different of financing because you do have to have the pen to stroke on that as an operator and be able to guarantee it. And really the process with that is every week how fast are we leasing? Because it's about how fast can you get it leased up to stop the bleed when you're doing a lease up, because there's going to be a loss as you're moving forward with it, because you got to staff it, you got to pay for insurance and taxes, and there's going to be a certain break even point that you got to get to. And so it's about speed getting to that break even point. On multifamily, there's still guys that are doing significant value add deals where absolutely bridge makes sense and interest only makes sense, and even floating rate debt makes sense.
Is it the norm though with self-storage? Let's just take the aggregate of deals. There's some value add, some stabilize. Is it typical to go after interest only debt on self-storage?
For sure.
It
For
is okay.
sure.
Okay.
Absolutely. And I mean, really, that's twofold. One, you want to own the asset as cheap as you can, right? But two, if you're coming in and you have a different business plan than what the existing person was doing, it's going to take you some time to get that business plan implemented. Even if it's an existing deal that's stabilized, there's still certain things you want to do. The big buzz in self-storage right now, and you'll see it with the REITs especially too, is ECRI. ECRI stands for Existing Customer Rental Increase, meaning new leases that are coming in are far less than what the existing customer base is paying. And so what they keep doing is they keep bumping up their existing customer base, keep increasing to increase the revenue while just trying to backfill the occupancy that they're trying to build. And then they'll keep building those people up because they become sticky clients, right? Your customer base becomes sticky. And so, but think about it too, right? If you have, let's just say you have a 10 by 30 unit, a big unit, right? So it's 300 square feet. And they go, hey, we're going to bump you up, $15 this month, right? And that's what it's going to be. And that's one of the benefits of self-storage compared to multifamily is it's month-to-month contracts. Well, if you have 300 square feet of stuff, are you really going to, hire U-Haul, get all these things and just move it to someplace else that's a little bit cheaper? Or are you just going to go, man, for the $15, I'll just go ahead and pay it and just hold on to it until I'm ready to move whatever is in there out.
That's a challenge for underwriting because, in apartments, just ask your neighbor, hey, what do you pay a month in rent? My God, I need to go talk to the landlord, right?
Yeah.
So you're never going to talk. You don't even know who your neighbors are in self-storage.
Correct.
Is that sustainable? And is that a house of cards?
Man, that's a great question right now, because if you look at some of the deltas between the larger REITs, and there was a big article just actually put it out by, I'll give him a shout out by Noah Starr at Track IQ. And he went through the very specifics of the REITs and the deltas between the strategies and the deltas between what they have, meaning Extra Space, which is a monster out there. Their existing base is paying somewhere between 15 and 18% more than what their even asking rents are. Now think about that. You can go and look at a deal and the physical occupancy could be, let's just say 85%. You're underwriting it. But the economic occupancy could be 95% because of the collections of what they're charging the existing. So you're right. From an underwriting perspective, that becomes a challenge because you have to sit there and go, well, hold on. Market rates or street rates are X, but you're collecting Y. And so you have to build in what's called churn. You have to build in some kind of churn ratio that you're going to make for that specific underwriting. And it does become quite a bit of a challenge when you're buying existing facilities that way.
So you hire an MIT statistician to figure out if you're going to make money or not.
Well, it's definitely become something. What you just brought up is something that's really, I would say, in the last 6 months, become something more of a concern. And so at SSA this year, and most recently at TSSA, we were in October, which is our big self-storage associations, right? It is definitely something that everybody is talking about is what is the most appropriate way to do these underwritings for these deals, because it's causing issues too with a lot of the brokers, right? Because if you present something that way, I mean, I've seen deals presented where the economic occupancy is over 100%.
How does that work?
How does that work, right? But the economic occupancy is over 100% because what they're charging the existing base so far exceeds what the street rates are. And you sit there and you go, well, if I come in, I almost have nowhere to go but down. So how does that make sense, right?
You have a declining asset, right?
That's right.
What's terrifying about self-storage is that a lot of municipalities don't limit new growth. So you can have a little bit older facility. Somebody could build a brand new one across the highway from you. Does that worry you?
It does. And so one of the things that we look at when we're doing our initial underwriting, so when we first look at it, so per capita is one of the first things we look at, right? And so using demographics and things like that, we will look at where we are from a delineated market area. So 1, 3, and 5 mile radius from the property, right? I want to know how many people live in these areas, the demographics of those people, meaning does my unit mix fit what the needs are for these, for the people that live in this area? How many other storage facilities are in this area by the square footage too, which would give me my per capita. And if you're below, let's just say you're below 8 square feet per capita, it's probably a decent market. But then you also need to check permits and see who's got what could be coming in, right? And does that shoot that up to 20 feet per capita? And wow, now I know I'm going to have issues just getting up to stabilization because there's going to be so much competition associated with it. The other thing that we look at too is the actual REITs that are in the area. One, their cost of capital is far less than mine, right? And two, they're motivated differently because they're publicly traded. So it's really what they report each and every quarter and what they're going to spend to go get that occupancy, whether however cheap it may be, they're going to go out there and buy it. If they're buying up all the occupancy in the area, how do I, small guy, compete with those people?
You're making me nervous. Should you sell all of your self-storage?
Not at all, because here's the other benefit of that, right? If you go into it knowing these things, where you're at, and how you're going to compete, right? All you have to do is sit there and go, look, when they keep doing ECRI and finally they're going to knock somebody out, I want to be the guy who's there to go, hey, here's how I can market. Here's how I can help you out with this particular thing and hold on to that customer. Because just like in multifamily, storage is the same. It's not necessarily the new lease you go and get. It's the one that renews and you keep. That's where you really make a lot of your money.
Are you raising capital preemptively for a rainy day fund?
Not yet. No. And I would tell you, if we did, it would be in a fund structure, but it would be very specific and very niche for whether it be a distressed assets or things of that nature. We've still have had great success going deal by deal, and I really don't see a reason to change that just yet.
Okay. So you're not getting these deals. Really, the larger deals are not going to foreclosure. They're still in the bank's hands. They're churning a little bit.
No, I mean, that's the other thing. We look at all the foreclosure notices too. And so just because something's posted for foreclosure, it doesn't necessarily mean that's the day it's going or that it forecloses at all. But what it does is it tells us right now, okay, we know an operator that's in trouble, or we know a deal that's in trouble, right? And that's public knowledge too. So foreclosure listings are public knowledge. And it's real quick to go, all right, if we know, and we normally know ahead of time before it actually gets onto foreclosure notice, right? But we know where it is, what it is, who it is, and how we can go ahead and communicate with them.
How is it that you know ahead of time? Is it just the inside knowledge and the relationships you have?
Correct. A lot of times too, they will already start listing it. They will already have listed it prior to it getting to that point, right? Because, I mean, think about it. If you're an operator, you know you're about to lose your deal because you can't keep affording it. Sell. You're going to have to sell it, whatever you need to sell it at. But you're going to try to make as much money as you can. And if you can't get to a deal to sell it quickly in that time frame, the blood's in the water, and a lot of buyers already know it.
Would you benefit by acting as a court receiver?
There becomes some conflicts associated with that. I'd much rather be the owner of the deal.
Because you may not be able to buy it, right?
Correct. I'd much rather be the one buying the deal.
Okay. And for the best ever listeners, a court receiver is essentially a property manager assigned by the courts to stabilize a property. And they do a horrible job of doing that usually.
They're there to collect a check for a lot of times.
Exactly.
That's what a lot of them are doing. It's just to keep the place from burning down and wait till the next buyer comes in.
Do you have relationships, or do you develop relationships with court receivers to find?
We absolutely do.
Yeah.
But you know how easy it is to become a receiver?
The ones that I've run into have done a horrible job, so probably pretty easy, or no?
Driver's license.
Okay.
If you have a driver's license, you can literally file to become a court receiver.
And they don't get paid a lot, do they?
Not typically, no.
Okay. Interesting. Well, Sam, what an incredible conversation. I'm going to ask you a question, and I'm not going to hold you to it. What is the Fed going to do next?
Oh, gosh. Well, I tell you what, I always, when people have asked this to me in the past, I've always said if I absolutely knew the answer, we'd probably be having this conversation on my own island somewhere. I would say that the markets are suggestive that on the 18th, we're going to have a reduction in rates of a quarter point, which would mean we would have dropped 100 bips for 2024 as of this recording, I should say. Whether 25 bips or not, it really doesn't mean a whole heck of a lot. that's not enough to be impactful. It's going to be rates moving in a substantial manner that are going to really be impactful. And with what we've talked about from a distress standpoint, if rates do move in a substantial manner, and particularly with treasuries too, the window to acquire distressed assets will close. I mean, just because you'll have something where positive leverage will come back into play, and it'll make a lot more sense for buyers to acquire, even at slightly elevated rates, because cap rates will be compressed. But yeah, it feels like we're going to have another reduction in December at this point. Although I would say, some numbers just came out yesterday. Inflation was actually slightly higher, 2.7%. Jobs still look strong, and where we're located in Houston, Texas, right? They're real strong out here. I mean, we've had more job growth, in Texas than anywhere else in the country. And in Houston in particular, I think no other cities have added more jobs, even, all throughout COVID to now. So if they didn't drop anything, it would probably be adequate. The markets may not like it, so you'd probably see some reaction associated with that. But everything that the interest rate market is telling us right now, everything that the stock market is telling us right now, the people who really bet on this kind of stuff, it shows like it's going to drop a quarter point on the 18th. But I can't say that with certainty, and I hope nobody else says that they're certain on it, because if they are, I'd be weary.
I lied about that being the last question. Can we achieve a soft landing after the longest bull run in history?
Yes. We can. A lot of it's going to depend upon jobs in particular, more so jobs. And so it's not something that's heavily talked about, but you will see Jerome Powell. I mean, he'll tell you the Fed mandate is inflation and jobs, maximum job and minimal inflation. So they'll tell you that's our two mandates, right? And I know people have vilified Jerome Powell and said, what a terrible job he's done and how terrible the Fed overall has done. I would actually say it really does kind of feel like they've done a pretty good job with what they've had and the information that they've had. So you need the villain to blame for interest rates increasing, and Jerome Powell seems to be that guy. But I would not want that job. He has a tremendous job on his shoulders.
It's a thankless job, and it's only years later that do they get vindicated, right?
Correct.
Yeah.
Yeah,
Sam,
and in this case, many years later, I'm sure.
Yeah. Sam, how can the best ever listeners reach out to you and find out more about what you're doing?
Yeah, easiest way to reach out to us is go to our website. So we're sunset-capital.com. It's the easiest way to find out about us, what we do, and learn a little bit more about me and our team. And we love talking with new people. We absolutely are looking for more passive investors to come into deals with us. We're a highly technical group, so we appeal to a lot of highly technical people too. And so, but enjoy meeting everybody we can meet, and really appreciate the opportunity to speak with you, Ash.
Sorry, Sam. If you don't mind, I'm going to ask one more question. You offer these investment opportunities as individual deals, not in a fund.
Correct.
How do the returns stack up on self-storage versus multifamily right now to
Very
investors?
similar. Yeah, okay. Very similar. I would say cash flow is maybe a little bit better on storage side, but overall returns are very similar.
Got it. Well, Sam, awesome. Thank you again for your time. It was a pleasure having this conversation.
Absolutely, bud. Really appreciate it.
Hey, best ever listeners, thank you as well for joining us. If you enjoyed this podcast, please leave us a 5-star review. Share this episode with someone you think can benefit from it. Also, follow, subscribe, and have a best ever day.